All right, so a couple of other announcements besides the Career Expo. Homework 8 is on your plate now and will be due on Monday, October 18th. So today's in-class exercise plays into that assignment. I'd encourage you, when we do the in-class exercise today, be sure to save your Excel file so that you can come back later and use that as you work on the homework. Just a plug to continue working on the project, and I'll introduce a couple of information sources here in just a moment so that you can start moving on from, hopefully you've already been doing background research on your probable income in your career, and maybe you could get some more of that information today over at the Career Expo. But the next phase of the project after thinking about income is expenses. And so I've got some details to share with you about that. Now, classes on Friday last week and Monday this week were a recorded lecture. We didn't meet. On Friday I was traveling to a funeral in Idaho, and then on Monday I was running the Boston Marathon. So you had to watch a video, and I wanted to emphasize that that is a really important topic. External rate of return. If there were ever two classes not to ignore, it's class 20 and 21. It absolutely will either be on the final or the exam, and maybe both. So I regret that I wasn't able to give that to you in person, but it's critically important that you're able to do an external rate of return. So if you just follow the video, step by step, the video goes through how to set it up. The template file is provided. You need to be able to perform an external rate of return. Otherwise, you're really going to be sorry when exam time comes around. So I want to offer and reiterate my assistance that, if you have started on the in-class exercise or the homework and you can't quite figure out how to do the external rate of return, bring what you've been working on to me, or give me a call on Teams, and we can share screen and I'll look at your spreadsheet, and I really want to help you learn how to do this external rate of return. Today we'll move on to a new type of analysis called incremental rate of return. Does anybody know why we do external rate of return and incremental rate of return? Like, what's the point?
Maybe like accounting purposes?
Accounting purposes? That's definitely part of it, yeah. The main thing about this course is decision making. How to know whether to choose one project that your company could do or a different project. How to know whether to purchase one piece of equipment or another piece of equipment. And so your responsibility is to maximize value for your organization, whether that means maximizing profits for the shareholders or maximizing returns to the people that your organization is meant to benefit. You're trying to find the best approach. So all of these different methods and techniques, it's not just about getting buried in a spreadsheet, but it's all about decision making and picking the things that are most beneficial. So incremental rate of return allows us to compare alternatives and identify the one that's most valuable. Now, back to some ideas about the project. I wanted to show you a couple of data sources where you could get information about cost of living adjustments. Here is on the Social Security Administration website a table of data that shows over the years how much they increased their payments to retirees based on how expensive things got in the United States. And so this is how much the federal government gave extra to people each year when prices went up. And largely, many companies will follow the same trend of increasing salaries. Even when people don't get a raise, your salary may go up a little bit to keep pace with the rising cost of goods. So I'm going to send you this link today, and what you ought to do is look over maybe the last decade and calculate the average increase per year, and then apply that to your income assessments. So if you know that you're going to be making $50,000 a year when you graduate, then maybe the average of this is 3%. Then what you'd assume is the year after you graduate, you're making $50,000 plus an additional 3%, because your employer will be giving you these periodic raises just to keep tabs on the rising cost of goods. So I'm going to send you this link today, but I wanted to give you a little bit of background on what it is. It's to help you with that spreadsheet, which is so many rows of data projecting into the future by using the past as just a stepping off point. Very closely related, inflation. So cost of living, this is how much income increases. And the reason why they give extra money is because of inflation. But we can also measure the inflation itself. So these two things are very closely related. The inflation is the cost of goods going up, and then cost of living adjustment is just how organizations increase their pay scale because of inflation. So there's a pretty good data source here, macrotrends.net, that allows you to graph information like for the last 5 years, what was inflation? So inflation in 2018 was 2.44%. Almost certainly for 2021, it'll go up. Inflation over the last 10 years. So you can get an idea and kind of look at, there were some years where the cost of living was really low. Cost of living adjustment in 2015, they gave 0%, because in 2015, the inflation rate was 0.12%. Now this is just the graph below it is compared to the previous year. So it's the blue line that you need to keep track of. So inflation was really low in 2015, but then it went up and it went a little bit down again, and now it's going up. So those are both things that you need to work into your project. Your project needs to show that your expenses are going up over time as goods become more costly, and your income is going up over time because your employer will be giving you more money, both because of promotions, but then also cost of living adjustment. So does everybody understand those 2 points? Okay, so I'm going to email you those 2 references, and you can use others as well, but I wanted to just show you that as an example of information that you can find in like 3 seconds with a Google search. I just found those links this morning. Now, sometimes people make the mistake on the project of making a budget rather than a cost analysis. A budget is when you kind of set a limit for yourself on how much you're going to spend. And you know, it's a subtle distinction, but a budget would be saying, I'm going to allocate $500 a month for rent, $100 a month for utilities, and then trying to keep within that limit. You know, maybe towards the end of the month, if you are getting close to your budget, then that means that you'd start spending less. So that's not what I want you to do for the project. And the telltale sign that someone is going in the wrong direction is these round numbers, 500, 100, 300. That's not based on any real data. That's just, those are numbers that were pulled out of thin air. What is okay is if you go find an actual apartment that's for rent in the place that you plan to live and take a screenshot of the listing, and then that is proof that it's a certain number of dollars per month. So if you break down your food, for example, into a little bit more resolution, rather than just like a broad lump sum amount for the month, if you looked at the food that you eat in a week, maybe you could go as far as identifying the individual items and the price of those items, and then adding it up so that you know a weekly cost estimate for your food, and then multiply that by 52. Your monthly utility estimate. You know, you're not just going to say $50 a month for water. You actually ask your parents what they spend for water. Or, you know, go to the American Water website and find out what is their tariff. You know, find some actual data source for these numbers that you're including in your cost estimate.
With those numbers, is that like, do you have to see those numbers, or is that just to help us get our final numbers?
Great question. In your report, you should explain to me where your estimates come from. And so you should tell me about what process you went through to determine your food budget. Or, did I use the wrong word? Your food estimate. You could put a spreadsheet together where you have all of those things like in a separate tab in a spreadsheet. The question is, you know, do you need to show me? The answer is yeah, you do need to show me. Like, show me the work that you did. Help me understand like the lengths that you went to take this project seriously and really make the plan that you're putting together something that you could use in the future as a starting point. Yeah.
You said we could do this on Excel?
Mm-hmm.
Make a big
Yeah,
sheet and
yeah.
just take the sum?
You can do it on Excel, but that doesn't excuse you from the written report.
Right.
So, you know, you couldn't say in the expense section of the report, you wouldn't say see Excel, because I don't want to go through a big cumbersome spreadsheet. I want you to explain the method that you used and then you could use Excel for the calculations. And so that would save you a lot of math, but you still need to kind of give me the overview and the strategy and what were the data sources that you used, because Excel would be a bad way to identify where the information came from. But it's a good way to actually multiply 85 by 52, and find out how much you're spending. Yeah.
So on the Excel sheet, could we say refer to the approximation.pdf?
Your citations should really be in the report, not in the Excel sheet. You can put it in the Excel sheet. I'm not going to penalize you if you put your citation in the Excel sheet, but all of your citations and references need to be described in the body text of the report.
Explanation though, of say how you got that budget.
Don't put that in Excel.
Could you have that in individual PDF though, and say in the Excel to refer to the PDF you put together for that?
You should have one report that I can read to understand everything you did.
Okay.
I don't have the ability with 48 students to go through multiple files. There's going to be one Excel file and one report.
Gotcha.
All right.
Thank you.
Yep. Okay. This project, I hope, will be genuinely valuable for you to see. The main thing that I hope is that you see how impressive compound interest is. Because when you see how just a little bit of saving now, when you're young, snowballs into just an absolute fortune by the time that you are ready to retire, then I think the whole course is a success. If you see the effect of that and then kind of make a resolution that you're going to save a bit of money while you're young, because you can have a really comfortable retirement if you take these things seriously when you're young, or you can really feel stressed out and uncertain through all of your life if you put off saving until later when compound interest can't really work its magic anymore. So in your report, you have to describe where the data came from and what the assumptions are. Help me to understand what you're assuming and what you did. All right, so today's topic is incremental analysis. And incremental analysis is where we're comparing two options. So let's just look at what we got here. Option A, we're buying something for $40,000 up front, and so it's cheaper than option B. Option B costs $60,000. But it looks like option A, even though it's cheaper up front, it costs more to maintain. Look at the operational costs. Option A costs $25,000 a year, and that may be fuel, maybe it's insurance, whatever. Its annual cost of operation is more than option B. So it looks like option B, maybe you're paying more up front, but then it costs you less in the long term. And then at the end of the useful life, option B also has a little more salvage value. So the question is, which should you do? Should you do option A or option B? And for us to answer that question, we have to know what interest rate applies, because this money in the future has to be discounted to the present at some rate. So we need to know the rate and how long of a time period we're comparing these two options. So one of the ways that we can compare alternatives is with an incremental analysis. An incremental analysis says analyze the difference between the two things. So option B minus option A. Let's analyze how they're different. So option B is $20,000 more expensive, and option B costs less per year. And so the difference between the two is $6,000 of advantage in favor of option B. So this $6,000 is positive because it's B minus A, and A is negative. So does everybody see why the annual cost is a positive value for the increment? The increment is the difference between them. And so although option B is more expensive, the incremental cost is positive, and so is the incremental salvage value. So B minus A is the increment, and we put A, the cheaper one, on the left, and we put B, the more expensive option, on the right. That's just kind of that's the way we're going to do things, is we're going to order them from left to right, cheapest to more expensive. And it'll work into the technique that we use for analysis when we do incremental analysis. All right, so the difference between them, when I say the increment, I mean one minus the other. The more expensive first cost minus the less expensive first cost. So this is the incremental cash flow. Now, the question is whether this extra $20,000 upfront cost is justified by the savings of $6,000 a year and by the added salvage value. That in an incremental analysis, we're trying to answer the question, is the extra cost worth it? So let's say that this option lasted for 4 years. These are different numbers than the previous example. I'm just showing you now a similar kind of setup. Option A and option B, first cost $60,000, first cost $73,000. Option B returns more revenue than option A does. Now, if we do a present worth analysis, discounting at 10%, then the sum of the present worth for option B is higher than option A. And so we should choose option B according to present worth analysis. If you watched the video from Monday, you already know that you can't trust internal rate of return to pick the most valuable project. Does anybody remember the why? Why you can't trust internal rate of return when comparing alternatives?
Isn't it because it's like relative to something?
It's relative to the initial amount that was invested. That's right. So option A looks like it does have a higher rate of return, but because option A costs less money up front, it doesn't matter if it has a higher rate of return. What matters is you want the most dollars possible. You're either going to do B or you're going to do A. So if you do A or B, you have your choice. Do you want $10,000 of profit or $9,000 of profit? I'd choose $10,000 of profit. It doesn't matter if the rate of return on option A is higher. Option B is the more valuable alternative because you're able to pay a little bit more up front, but then you get even larger returns each year. So it's worth paying more up front, even though option A has a better percentage. So I explained that in the, that's one of the things that we went over in the recorded lecture from Monday. But what if we looked at the increment? So you'll notice A is on the left because it's the cheaper alternative compared to B. So if we did B minus A, the increment, option B is $13,000 extra, and you get an extra $4,225 each year for 4 years. And so the incremental present worth is positive. And this, by the way, is discounting at 10%. When you find the present worth, what you're doing is you're taking each one of these 4,225s, you're moving it back to times 0, and you're looking at, is the extra $13,000 you spend justified by the additional annual revenue? So this extra revenue you get for going with B instead of A, is it justified? And the fact that the present worth is greater than 0 when discounted at the MAR gives you the thumbs up, it's justified. And another independent way to verify that it's justified is that the internal rate of return of the increment is above the MAR. So this 11.4% is saying the $13,000 extra, that difference between the two, if you spend it, you're making 11.4% on the increment. So the project overall, option B, as a whole, has a rate of return of 16.3%. But we can go further. We can analyze what's the rate of return of the difference between B and A. And since the incremental rate of return on the difference is greater than the MAR, that tells us we should choose B. So here's our decision criteria. I've used that phrase before, decision criteria. It's kind of like the rule you apply to know which option to choose. And the decision criteria is if the internal rate of return of the difference is greater than or equal to the MAR, then the additional investment is justified. So you should spend, this is you telling your boss. Tell your boss, yes, let's spend that extra $13,000 because we can go to the bank and borrow that money for 10%, but we're going to get 11.4% return. So it's like an extra $393 in profits. I mean, that's not any huge sum, but you take all the profits you can get. So it's justified, choose option B. So does everybody understand both the incremental analysis and also the decision criteria we apply? Any questions so far?
So this is has one of those things where it's like it's built in that like you're gonna take like the difference and invest it at like the rate.
Yes. So you're asking about the assumption built into internal rate of return?
Yeah.
Yeah. So it's okay to use the internal rate of return on an increment like this. Yep. All right. Now there's a lot of different ways the letter I has been used this semester. And so now we're 20-something lectures in, 22 lectures in. Let's take a moment to pause and differentiate between some of the ways the letter I has been used. So if it's a capital I, that means the interest amount, and it's talking about some number of dollars. If it's a lowercase I, that's an interest rate where it's expressed as a percentage. I star is the variable that we assigned when we're talking about the rate of return on a project or the rate of return that has to be paid on a loan. So the internal rate of return is one of these types of I star, and that's where you're assuming the earnings can be reinvested. I prime is what we talked about in the recorded lecture from Friday and Monday. It's the external rate of return. Sometimes that's abbreviated EROR, external rate of return. And within that method of external rate of return, there's this external reinvestment rate. And I won't go into all of the depths of explaining what that is, but basically when you have a project that can't accept reinvestments into it, let's say you own an ice cream shop, but you already own it. You can't take all your profits and reinvest it into the ice cream shop. So you're taking your profits and you're putting it somewhere else, maybe into a bank account or into a second business. Wherever you're putting the profits, you have to know what's the rate of return of that secondary investment, and that's the external reinvestment rate. And knowing that is one aspect of calculating the external rate of return. So the external rate of return includes the effect of the external reinvestment rate, I sub I. And finally, what we're doing today, delta I star. So delta means the increment or the difference. So it's the analysis of the difference between two options and find the rate of return on that. So I star means we're finding the internal rate of return. All right, so this slide is in the notes if you want to make up flashcards or impress your family with terminology and all that. Now, let's walk through a complicated scenario. So far we've just looked at when there's only two options, A versus B. It gets a little bit more complicated what to do if you have multiple options. So here we have 1, 2, 3, 4, 5 options. Now this part that's on the right, it doesn't really exist yet. So you can't know up front what the matchups are going to be. I'm going to call it matchups. They're comparisons. So I almost don't want to show this to you, except for I have to have this in the slide so that you've got it for later. But what I want to emphasize is at the beginning of the analysis, you don't know what all of these comparisons are going to be because first you have to do the internal rate of return analysis. So step 1 on the incremental analysis is do an initial screening to see if any of the options should be thrown out. And so our MAR, minimum attractive rate of return, is 18%. And so here I've done the IRR function on all of these options, and all 5 of them have an acceptable internal rate of return. So they all pass the initial screening. But let's say, what if option C was a no? What if it failed the initial screening? What if the internal rate of return was 12% for option C? So if it was thrown out during the initial screening, then we wouldn't do any incremental analysis, because if it doesn't pass the initial screening, we don't have to do a head-to-head matchup between a failed option and some other alternative. So that's the first thing I want to mention, is that anything that doesn't have an acceptable internal rate of return doesn't move on to the next phase. All right, so now let's talk about the next phase. The first thing that you do is you compare the cheapest alternative to the next most expensive alternative. So the cheapest one is A. You'll notice I put these in order of cheapest to most expensive. Just to mess with you, I'm not always going to give you those options in that order. So you have to put it in the right order of the cheapest option on the left, the most expensive option on the right. And it's not just actually to mess with you. It's because in the real world, the data you get is not going to be in like chronological order or cheapest to most expensive. You have to make it a habit of organizing the data so that it follows the methodology that's required. Okay, so the first matchup, B versus A. When I do the B versus A matchup, I don't know yet what any of the rest are. So I only do one column at a time. I can't put all of these titles in them yet because I don't know what any of the other matchups are going to be until I know which alternative comes out on top between B and A. Because if A is the best option in that first matchup, then the next comparison will be between A and C. So I can't write the titles for these until you know which alternative is the best. So B versus A, we do the difference in cost, the difference in revenue, and the incremental internal rate of return is 22%, which is greater than 18%. So our conclusion is accept B. Do the more expensive alternative because the rate of return on the difference between the two is more than our minimum. So because B won the first comparison, the next comparison is C versus B. And so we don't yet know any of the others. We're just looking only at whichever came out on top between the first two versus the next one in line. C versus B. So we go down through the incremental rate of return, 43%. That's a good one. So C is justified. We ignore from now on. We've thrown out B, we've thrown out A, and C is our new champion. So we now compare D and C, and in this analysis, the rate of return is 0. So that tells us D is no good. It's not worth doing because the incremental internal rate of return is less than the MAR. So we stick with C. In the matchup between D and C, you can see down here in the conclusions, I'm saying keep C. And then the final matchup, E versus C, we find the incremental cost, the incremental revenue, the internal rate of return. At least it's not 0 this time, but it's still not up to standard. The standard is it has to be equal to or greater than the MAR, which is 18. And so since it's below that, we reject E and keep C. So the overall winner is that option C is the best alternative. That's how we're going to maximize our profits, and the incremental analysis proves that. And here is the incremental analysis that you are going to do today. In the in-class exercise, we've got some options. Each of them have a 10-year lifespan. So you're going to set up a spreadsheet that looks like this. I don't have a template for you. You're starting from scratch. You're going to have a column. You're going to have interest rate at the top, a column for time, a column for the options. Now, for the options, please don't call them A, B, C, D, and so on. That'll be confusing because my solution calls it C, K, V, H, D, and A. So we're just abbreviating the company name with the first letter. Each one of them we know what the cost is, and so the capital investment, that's an outflow. So when you put it in the spreadsheet, that's a negative number. We know the annual revenue, and it's a 10-year lifespan. And so what you need to do is, first of all, with the initial screening, calculate the internal rate of return. And hint, one of them you're going to throw out because it doesn't pass the initial screening. And so then after the initial screening, you'll have all these subsequent matchups to compare one option to the next. Okay, so I'm going to pause for a moment and I'm wondering which side should I leave up. Should I leave up this in-class exercise slide, or should I leave up the slide that shows the previous illustration? Any thoughts on that? Does everybody have the in-class exercise? Okay, so I'm going to leave this slide up so that you can kind of, you have your own spreadsheet, and this will be on the screen as a guide for what you ought to be, what your template should look like, and the direction you need to go with your analysis. I have the answer, so I'll circulate around. Raise your hand if you have a question or if you want me to check your work to make sure it's on the right track. I'm going to start setting up my spreadsheet on the screen here just to make sure that we all have the same idea with what it needs to look like. So your spreadsheet should look like this so far. So we started with 6 options, and 5 of them are acceptable. The Komatsu needs to be rejected because its rate of return, 8.9%, is less than the minimum. The minimum is 12. You'll notice these we're just using the IRR function for this initial screening. And of the 6 options, Initial screening was passed by 5 of them. So our first option is going to be the cheapest, our first matchup is the cheapest and then the next most expensive option that passed. So it's not K versus D, it's going to be C versus D. So we're going to do C minus D, the more expensive minus the cheaper. So equals option C minus option D. So the incremental cost between the two is $25,700. I'll just drag this down and it'll calculate the incremental benefit for each year. And then here I'm going to calculate the internal rate of return on the difference between those two options. And the incremental rate of return is 11%. Let's just make sure, yeah, 11.2. That's not enough. It needs to be 12% if we give the next most expensive alternative the thumbs up. So in the matchup between C and D, D is still on top. So here let me write the interpretation of that down here. The interpretation is, since the IRR of the increment is less than the MAR, stay with the cheaper alternative. D is still our preferred option. That's a lot of text for that cell, but I just wanted to tell you the thoughts behind it. Okay, so now we've thrown out K and we've thrown out C. So our next matchup is between D, which is the reigning champion, and its next challenger is H. So H minus D. All right, so we just do H minus D, find the incremental cost, the incremental revenue, and I can just drag this formula sideways, internal rate of return. So the internal rate of return between these two, 18.6%. So now we'll say keep H. H wins. Deere, the previous champion, is thrown out in favor of Hitachi. So now it's going to be Hitachi versus Volvo. So V minus D. So Volvo minus Hitachi. We find the incremental cost. And we'll do the internal rate of return on the increment. Ooh, negative 12%. Okay, reject Volvo. Reject V, keep H.
You typed in D in the top cell.
Oh, did I? I typed the wrong thing?
Yeah.
Let's see. Yeah, it was supposed to be, hold on a minute. Yeah, V minus H. So I typed in D when I meant H because in the matchup of H versus D, H was the winner. So our next comparison is V versus H. Thank you for noticing that.
Does that mean we need to work it out again?
No, the numbers were right. I just had the wrong label. So this was a comparison of V and H.
I did get here.
All right, so our last matchup is A, Atlas versus Hitachi. So let me do that. Equals, Atlas minus Hitachi. Okay, so this minus that. Hitachi is way cheaper than Atlas. Let's see what the internal rate of return is on the increment. I don't have a good feeling about this. 7%. So reject Atlas, keep Hitachi, and then down here, our overall winner of the incremental analysis is Hitachi. So it's the best option. Hitachi is the best option. In this fictional example, this isn't real world data. I just made this up. So we went through and we picked the best alternative based on the incremental analysis. We could also verify it just to double check. We could see what's the net present value of each option. And the one with the highest net present value should be the option that we just found. So let's just make sure that Hitachi is the best. So I'm going to do the net present value. So equals NPV, and the rate I'm using is this MAR. And here's my values. Warning, when using the NPV function, only put values in there that are in the future. So I'm not putting in the amount that's already at the present. The amount that's already at the present, I add outside of the NPV function. So I can calculate the NPV, the present value of each of these alternatives, and verify the one that gives me the most profits is that Hitachi, which we had also identified as the best option through incremental analysis. The benefit of the incremental analysis is that you know specifically what your rate of return is on the extra amount you spend compared to the next best option. So it gives you a bit more data. We're out of time. I have a feeling that probably some people didn't get through this, and I would encourage you to watch the video. It'll be on YouTube in about an hour. Let's just finish with one last look at these announcements that you've got a homework assignment due on Monday. I'll send you some links having to do with the project, and I'd encourage you to go over to the Career Expo. Just see what they got going on over there. Have a good one. See you Friday.
I'll show you that email.